I think you've got to look back what's happened over the last 10 years. And post-financial crisis, there were sort of 5 key issues that have made it quite an unattractive sector to invest in. So firstly, capital requirements went up 2 to 3-fold, significant. Liquidity requirements, similarly, because of, when you think the straw that broke the camel's back during the crisis was Northern Rock, the lack of liquidity. So it was key that banks increased their liquidity ratios. The next was a significant increase in fines and litigation. So obviously issues that happened mostly pre-crisis or just shortly afterwards. So close to $500 billion has been paid out by banks over that period. Regulatory costs have gone up, in some cases 5 to 6 times, so significant increase. So that's obviously hit costs. And then the final thing is probably the interest rate environment. So banks make their money out of the difference between what they charge for loans and what they pay to their depositors. And those margins got squeezed by very low interest rates. We have to go back to what I just covered on what were the issues why people didn't want to invest in the sector. So today, when you look at the banking sector, banks have significantly stronger balance sheets, higher liquidity ratios, so that they're safer in themselves. Secondly, risk in the sense of what they own within those balance sheets has gone down materially. So whether you think that's the type of loans they underwrite, mortgages. So pre-2007, you could get a 100% loan-to-value mortgage. Today, that's almost impossible. Another example would be leveraged loans. So very topical at the moment because the leveraged loan market has grown significantly and people are worried about the underwriting standards. In 2007, banks had $500 billion or thereabouts sat on their balance sheets. Today, it's probably 20% of that. So significantly less risk on the balance sheets. The next point is obviously regulatory costs and fines. They've gone up materially. And so going forward, if anything, they're likely to fall. And fines have fallen materially since 2013, 2014. So that's no longer a headwind. The unknown is the outlook for interest rates. So we talked about margins for banks getting compressed. Going forward, if interest rates go up, as they have in the US, then that's great for banks. Their margins widen and they make more money. But that's the unknown. So that's where we don't know where that may or may not go over the next, say, 10 years. But likelihood is it will probably go up. And then finally, valuations. So the sector's derated materially, whether you look on a price to book or price to earnings basis, and as a result is a much more attractive proposition for investors. So when we think about global financials, there's sort of 5 main areas where we're looking at. Banks, which is the largest part, insurance companies, diversified financials, real estate, and finally fintech. At the moment, we see significant opportunity within the bank sector. We've talked about some of the reasons for that. So stronger balance sheets, less risk, attractive valuations. The short term, we particularly like the US. The momentum in the US economy is stronger there, but we're seeing some significant opportunities within European banks. Very, very cheap valuations at the moment. Insurance, particularly non-life, we like, but we are perhaps a bit more cautious in the short term. It's a very defensive part of the market. And we're perhaps a little bit more optimistic on the outlook for banks. So we don't dislike it, but we see better value elsewhere. Real estate, we've pulled back a little bit from, because in a rising rate environment, that can act as a headwind, albeit we see some interesting opportunities in Asia, where we own a number of REITs. Fintech is perhaps the most interesting one long term. Short term, it's quite difficult to find things that are listed, maybe outside the payment sector. That's something that's impacting, obviously, the sector as a whole when we're looking to find more opportunities going forward. There's a number of ways to access this space. We launched the Polar Capital Global Financials Trust back in June 2013, so about 5.5 years ago, to provide investors with a lower risk way of investing in the sector. The trust was launched with a just over 3% yield. It's currently yielding close to 3.5% today. That dividend has grown by 7% per annum. And it has a flexible mandate to invest globally in the sector. Currently, the most significant exposure is to the US, but there's no reason why that couldn't change at some future date. So the sector's been out of favor, yet over that time, the trust has delivered around a 9% annualized return to shareholders, which is still very good, considering that. Financials tend to be seen as a value sector, so if value comes back in favour, it should do well. But particularly as the sector performed poorly last year, as it derated, then there's an opportunity at the moment for deliver even better returns than it has previously. It's the biggest sector globally, between 17 and 22% of equity markets, depending on how you define it. Institutions have generally been underweight it for the reasons we discussed earlier. And because of that, we think some of those risks are misunderstood, and therefore, looking over the next 10 years, actually the returns could be materially different to what they have in the last 10 years.